What makes a global entertainment giant like Disney, well, tick? It's really so much more than just the magic kingdoms and the characters we love.
Absolutely. It's a massive, complex business.
And the numbers, they tell this incredible story. Adaptation, big strategic shifts.
hmm
So today we're doing a deep dive into the Walt Disney Company's latest financial report. Specifically, their Form 10Q for the quarter ended June 28, 2025.
Right, the Q3 numbers.
Exactly. And our mission here is really to pull out the most important bits of knowledge, the key insights from this, let's be honest, pretty dense document.
It can be, yeah.
We want to give you a shortcut to being really well informed about the House of Mouse, whether you're a shareholder, maybe you go to the parks a lot, or you're a Disney Plus subscriber,
Or just love the stories.
or just love the stories. These numbers, they tell us a lot about where Disney's heading and, what might actually impact your experience. So let's unpack this.
Okay, so if we zoom out first, look the big picture. Consolidated performance for the quarter.
Yeah, let's start there.
The headline numbers are quite striking. Revenues increased solid 2%, up to $23.7 billion.
Okay, 2%. Seems steady.
Steady, yeah.
Yeah.
But here's where it gets really interesting, especially if you're trying to gauge the company's health. Net income attributable to Disney, it more than doubled.
Doubled.
Yeah, jumped from $2.6 billion last year to $5.3 billion this quarter.
Wow.
And diluted earnings per share, the EPS, same story. More than doubled. Hit $2.92 compared to $1.43.
Okay, those are some dramatic jumps. A doubling of profits, EPS, that definitely catches the eye. So what's the core reason behind such a huge leap? Was it just like more people flooding the parks or signing up for Disney Plus?
That's the crucial question, isn't it?
Yeah.
Because the real insight is in the drivers of that growth. And a major piece of that puzzle, it was a significant non-cash tax benefit.
Ah, okay, a tax benefit.
Yeah, about $3.3 billion. And this was recognized because of a change in Hulu's U.S. income tax classification. That happened after Disney fully acquired Hulu. So while those headline numbers look amazing, a huge chunk of that surge wasn't purely from, day-to-day operational growth. It was more of a strategic, one-time financial maneuver.
So it's not quite as simple as Disney just made twice as much money selling stuff. It was a clever financial move, boosting the bottom line. But okay, beyond that tax benefit, were there other positive things happening operationally?
Oh, absolutely. While that tax benefit was huge, the company also saw higher operating income from its experiences segment. Think parks and cruises and the sports segment.
Okay.
But these gains were partly offset by an extra payment they had to make to fully acquire Hulu and actually lower operating income from the entertainment segment.
Okay. So a bit of a mixed bag operationally underneath the big number.
Exactly.
Yeah.
And if we connect this to this sort of bigger picture for the year so far, the 9 months ending June 28th, total revenues were up a healthier 5% to $72 billion.
Right.
Net income attributable to Disney surged to $11.1 billion, up from $4.5 billion the prior year. And EPS, $6.12 compared to $2.46.
Again, huge jumps year to date.
Yeah, and the main drivers there. Again, that big non-cash Hulu tax benefit, but also the comparison to the prior year, which had some significant goodwill impairments.
Okay, goodwill impairments. That's one of those accounting terms. Can you quickly break that down for us? What does that actually mean?
Sure. So goodwill impairments are basically write-downs.
Yeah.
They happen when the value of an asset Disney acquired, maybe another company, drops on the books below what they originally paid for it.
I see.
So in this context, it just means the prior year's numbers looked worse because of those write-downs, which in turn makes this year's rebound look even more dramatic when you compare them.
Got it. So a powerful tax benefit, strong results from parks and sports, all amplified because last year had those accounting adjustments. Okay, that paints the overall picture much clearer. Now let's pull back the curtain. Where does Disney actually, make its magic and its money? Let's look at the segments. First up, the massive entertainment segment.
Right. So entertainment segment revenues, they increased just a modest 1% for the quarter to $10.7 billion.
Only 1%.
Okay. Yeah, but for the 9 months, it was better, up 6% to $32.3 billion. But here's the interesting bit. Operating income for the quarter actually decreased 15% to $1.02 billion.
Down 15%, even with revenues slightly up.
Exactly. But then, for the 9-month period, operating income showed a strong increase of 39%, hitting almost $4 billion.
So that raises a question, doesn't it? What's going on inside entertainment that gives us this, mixed picture? Revenue growth overall, but a quarterly profit dip.
That's the key, because entertainment is where their direct-to-consumer streaming services live.
Yeah.
Disney plus Hulu, ESPN plus free.
Right. The DTC business.
For DTC, subscription fees were up 10% for the quarter. That was largely driven by price increases they've put through and some subscriber growth.
Okay, so people are paying more.
They are. But this was somewhat offset by uh, unfavorable foreign exchange impacts, the strong dollar, and also the impact of the Star India transaction.
Ah, yes, the Star India transaction. Remind us what that involved.
So that refers to Disney basically divesting its Star India businesses. That included the streaming service, Disney Plus Hotstar.
Right.
So when we talk about its impact, it's because those assets aren't fully part of Disney's operations anymore, which messes with the year-over-year comparisons.
Makes sense.
Also on the DTC front, advertising revenue. That was down 7%.
Down. Even with more subscribers.
Yeah, apparently due to lower ad rates, even though they actually had growth in impressions, meaning more ads were shown.
Okay, so the growth driver for streaming right now is definitely getting people to pay higher subscription fees, not so much the ad side. Interesting. What about the key metrics? Disney Plus specifically, how did it do?
Okay, Disney Plus domestic, that's US and Canada subscribers, were basically stable compared to the last quarter, sitting at 57.8 million, but still up 5% compared to last year.
Okay.
Their average monthly revenue per paid subscriber, AMRPU, for domestic Disney Plus sold, that went up to $8.09. They said that was due to higher ad revenue per user, offset by the mix of subscribers.
So higher ad revenue per user even if overall ad revenue was down. Interesting nuance. What about international?
International Disney Plus subs increased 2% just from the last quarter, up to 69.9 million, and that's up 6% year over year.
Still growing nicely outside the U.S.
Yeah, and international AMRPU rose to $7.67. That was helped by favorable currency exchange rates and those price increases again.
So adding it all up, where does Disney Plus stand globally?
Total Disney Plus subscribers are now at 127.8 million.
127.8 million. Okay. And what about Hulu? Especially now that Disney owns, the whole thing.
Right. Hulu SVOD only subs, that's the main on-demand service, saw a 2% increase from last quarter, reaching 51.2 million. And that's up a solid 10% from last year.
Good growth there.
Their AMRPU was $12.40. Again, benefiting from higher advertising revenue, though partly offset by subscriber mix shifts.
And the live TV part of Hulu.
Hulu Live TV plus SVOD subs. They were actually slightly down to 4.3 million, but their AMRPU is huge, $100.27, mostly thanks to higher ad revenue on the live channels.
Wow, that's a high AMRPU. So total Hulu subs?
55.5 million total for Hulu.
Yeah.
And yet, it's important to reiterate, Disney now has 100% ownership. They paid that extra $0.4 billion to NBCU back in June after the appraisal.
Right.
And that full acquisition, that's what triggered that massive $3.3 billion non-cash tax benefit we talked about at the start.
Got it. So the streaming story is really a mix of subscriber growth, price hikes working, some ad softness, and these big strategic moves like fully integrating Hulu. What about the costs? Are they spending more or less on shows and movies for these platforms?
Well, for Hulu, programming costs actually went up. That makes sense, mainly due to higher license fees they pay based on the number of subscribers. More subs, higher fees.
Okay.
But for Disney Plus Clip, programming costs actually decreased. And that was mainly because of that Star India transaction. The comparison was against last year when they still had the expensive International Cricket Council rights on Disney Plus Hotstar.
Ah, okay. So divesting that business lowered content costs for Disney Plus overall. Makes sense. Now let's shift to linear networks. The traditional TV business, ABC, FX, ESPN channels, carried on cable. What's the trend there? Seems like this has been tough for everyone.
It definitely has been, and it continues to face significant headwinds. Affiliate fees, that's what cable companies pay Disney to carry their channels. They were down 10% for the quarter.
10%? Ouch.
Yeah, primarily due to fewer subscribers cord cutting, though that was partly offset by higher rates they managed to negotiate, at least domestically.
Right.
Advertising revenue declined even more sharply, down 25%.
Wow, 25%.
Yeah, due to lower viewership and lower ad rates domestically, plus, again, the impact from that Star India transaction internationally.
So double whammy from fewer viewers and lower ad prices.
Pretty much.
Yeah.
And as a result, the operating income for linear networks decreased. It's down because of both the Star India deal impact and just the general decline in the traditional domestic TV business. It really highlights that ongoing shift, doesn't it, from cable to streaming.
It certainly sounds like traditional TV is under, well, immense pressure. Okay, now let's talk about content sales, licensing, and other. This is where Disney sells its movies and TV shows to other platforms, licenses its library, theatrical releases. How did this part do?
Here, revenues were actually up 7%. That was due to higher TV and VOD content sales, selling shows to other streamers or networks, and also theatrical distribution.
So movie theaters contributed.
Yeah, the theatrical side featured more titles this quarter compared to last year. They mentioned Lilo and Stitch, Thunderbolts, The Amateur, and Elio.
Okay, a mix of releases.
Right. And they also noted the performance of the live-action Snow White compared to Inside Out 2 and Kingdom of the Planet of the Apes in the prior year's quarter.
But how did that translate to profit? Revenue up 7% sounds good.
Well, despite the revenue growth, operating income actually shifted to a surprising loss of $21 million. That's down from an income of $254 million in the same quarter last year.
A loss? How come?
Primarily due to lower results from the movies released, the theatrical results weren't as strong as hoped, apparently, and also higher film cost impairments, basically writing down the value of certain films.
So movies are coming out, but maybe not all hitting their financial targets. It seems even a giant like Disney isn't immune to the challenges of predicting box office hits and managing those huge film budgets. That led to a loss here. Okay, now let's pivot. Sports segment. What's happening with ESPN and its related ventures?
Okay, sports. Revenues here decreased 5% for the quarter, down to $4.3 billion. But interestingly, for the 9 months, they were comparable to last year at $13.7 billion.
So a quarterly dip, but flat year to date. How about profit?
On the flip side, operating income saw a really healthy increase. It was up 29% for the quarter to $1.04 billion.
Nice jump.
And up 33% for the 9 months to nearly $2 billion. So that's a positive sign. Revenue's slightly down quarterly, but profits are up nicely. Suggest better cost management or something.
What's driving that improved profitability even with the revenue dip?
Well, looking at revenue drivers first. Affiliate fees were down 3% overall for the quarter. Again, partly due to Star India and fewer cable subs, even though they got higher rates.
All right.
Advertising revenue was also down 14% overall. Again, largely due to the Star India comparison last year. They had big cricket tournaments like the ICC events and Indian Premier League.
Right. Losing those cricket rights hit the top line hard.
It did internationally. However, domestically, ESPN advertising actually grew. That was driven by higher ad rates and expanded college football programming.
So domestic ESPN ads are doing okay. What about ESPN Plus, the streaming side of sports?
ESPN Plus's AMRPU, that average revenue per user, it decreased slightly just in the quarter to $6.40 from $6.58. They said that was due to lower advertising revenue. But looking year over year, it actually increased to $6.40 from $6.23. And that was thanks to price increases.
So pricing power helping there too. What about the costs for sports? All those broadcast rights must be expensive.
They are. Domestic ESPN programming costs increased. That was due to higher rights fees for the NBA and college sports. Plus, they aired one extra NFL game this quarter.
Okay.
But that was partially offset because they didn't have the NHL Stanley Cup Finals rights this year. Those air every other year on an alternating basis.
Right, the NHL deal alternates. And speaking of football, there's some really interesting news about the NFL, isn't there? What's the deal there?
Yes, this is potentially huge. ESPN and the NFL have reached a non-binding agreement. The plan is for ESPN to acquire the NFL Network.
Wow, acquire NFL Network.
And other NFL media assets like NFL Red Zone Channel and NFL Fantasy.
Okay. What does the NFL get in return?
In exchange, the NFL would receive a 10% non-controlling interest in ESPN itself.
So the NFL becomes a part owner of ESPN.
Effectively, yes. If this deal goes through, Disney would still hold a 72% controlling interest in ESPN, Hearst would keep its 18%, and the NFL would hold 10%.
It's a massive strategic move. What does this really mean for the future of sports content for ESPN?
Well, it could further cement ESPN's dominance, couldn't it? Integrating NFL Network and Red Zone, that creates an even more compelling package for fans. It's potentially a new model for how major sports leagues and media companies partner up. Really fascinating development to watch.
It certainly sounds like a game changer for sports fans and the industry. Okay, finally, let's talk experiences. Parks, resorts, cruise line, consumer products. This is often seen as, the heart of Disney, where the magic comes alive. How did this segment do?
This segment really shown just remarkable strength. Revenues increased a solid 8% for the quarter to $9.09 billion.
8%. Nice.
And up 6% for the 9 months to nearly $27.4 billion. Operating income followed right along, up 13% for the quarter to $2.52 billion and 7% for the 9 months to $8.12 billion.
Those are impressive numbers. It clearly shows people still really want those physical Disney experiences. What were the specific things driving that revenue growth?
It was growth pretty much across the board. Theme park admissions were up 8%, mainly due to higher average per capita ticket revenue. Basically, guests are spending more each visit.
Okay, higher spending per guest.
Resorts and vacations saw a big 12% increase. That was driven by more passenger cruise days, reflecting the launch of the new Disney Treasure Ship.
Ah, the new ship effect.
Exactly.
Sure.
Plus higher occupied hotel room nights and more Disney Vacation Club sales.
Right.
Merchandise, food and beverage revenue was up 7%, also due to higher average guest spending and just more volume, people buying more stuff.
Makes sense.
Merchandise licensing and retail was up 3% from licensing deals. And parks licensing and other revenue got a boost from a rebate they received and more co-branding revenue.
Okay, so strength everywhere. If we drill down into the parks themselves, what do metrics like attendance and spending tell us?
For the domestic parks, U.S. parks attendance was comparable to last year, pretty flat. But per capita guest spending was up a healthy 8%.
So same number of people, but they're spending 8% more each.
That's right. Indicates really strong value perception or maybe just price increases sticking. Hotel occupancy domestically was robust at 86%, and per room guest spending was up 2%.
And internationally?
International parks saw attendance up 1%, so slight growth. Per capita guest spending up 2%. Hotel occupancy internationally was high at 87%, though per room guest spending was actually down 3%.
Interesting dip on the international hotel spending per room, but overall, a really strong showing for experiences. What about the costs? Are they dealing with inflation or big investments?
Yes, operating costs were higher, partly due to increased operating labor, inflation, higher volumes needing more staff, new offerings. Infrastructure costs also went up for technology and operation support. And depreciation was up, especially from the Disney Cruise Line expansion. Launching a massive new ship like the Treasure comes with significant costs hitting the books.
Right, that makes sense.
But overall, the segment showed really strong growth, especially at the domestic parks and experiences. It proves people are still very eager to get immersed in that Disney magic.
Okay, so we've walked through the segments, the streaming shifts, the linear pressures, the content sales volatility, the sports consolidation, and the booming parks. Now, let's broaden out again. What about other important financial insights, like cash flow? Always critical.
Definitely. Cash provided by operations increased significantly. It was up by $5.2 billion, reaching $13.6 billion for the 9 months.
That's a lot more cash coming in. Why the big jump?
Primarily driven by lower tax payments. Remember those deferrals related to the 2025 California wildfires? That helped. Plus, just higher operating cash flows from entertainment and especially experiences.
Okay. And where is the cash going? Investing.
Yes, cash used in investing activities increased. That was due to higher capital expenditures, CapEx, particularly for expanding the cruise ship fleet.
Right, building those ships costs money.
A lot of money. The company expects its total CapEx for fiscal 2025 to be around $8 billion. That's a notable increase from $5 billion in fiscal 2024. So they're investing heavily back into the business.
$8 billion in investments, okay? And what about returning value to shareholders? Dividends, shared buybacks?
Yes, on both fronts. They declared another dividend of $7.50 per share. That's about $79 billion total, payable on July 23, 2025. They also paid one earlier in the year, same amount.
Okay, consistent dividends.
And share repurchases. They bought back 7.2 million shares for $2.7 billion just in this quarter. And for the 9 months, it's 23.7 million shares for $2.5 billion.
They're actively buying back stock then.
They are. The board authorized repurchasing up to 400 million shares back in February 2024, and there's still authorization for about 348 million more. The company is specifically targeting $3 billion in buybacks for this fiscal year, 2025.
So a clear commitment to returning cash to shareholders through both dividends and buybacks.
Exactly.
Now, thinking about Disney's overall financial health, how are they positioned? And what about the legal stuff? Feels like they're always in some kind of lawsuit or another.
Well, their financial health looks rock solid. They describe their condition as strong. They have bank facilities providing $12.25 billion in unused borrowing capacity, which is a huge safety net.
Lots of flexibility there.
Yeah. And they met their interest coverage covenant by a significant margin. For listeners, that's a key test from lenders about a company's ability to pay interest on its debt, and Disney's passing easily.
Good sign.
They also use derivative instruments, financial tools to manage risks from changing interest rates, foreign exchange rates for currencies like the euro, pound, yen, and others, and commodity price swings, standard practice for a global company.
Okay. And on the legal front, any specific cases we should be aware of?
Yeah, there are a few ongoing things mentioned. There's a securities class action lawsuit claiming they made misleading statements about Disney Plus costs and subscriber growth. That one's moving forward.
Mm-hmm.
Related shareholder derivative complaints are currently paused or stayed. Then there are antitrust class actions related to YouTube TV and DirecTV Stream, basically alleging unfair pricing or packaging involving Disney channels.
Right, the bundling issue.
Exactly. And another antitrust suit, this one by Fubo TV subscribers, making similar claims about bundling and seeking damages, potentially even asking Disney to sell off its interest in Fubo or Hulu.
Wow, that would be significant.
Potentially, yeah. There was also a settlement reached in principle in another case, the Biddle-Fendelander action, but it fell through because the lawyers couldn't get the final authority. So that one's still technically active. Most of these are in early stages, though, so Disney says they can't reasonably estimate any potential loss amount yet.
Okay, lots of legal balls in the air. Beyond the courtroom, what broader risks is Disney highlighting? Things that could impact their future.
They list several key risk factors. One is potential misalignment with public and consumer tastes. That includes the impact of how the company is perceived on public interest matters, environmental or social issues, how people feel about the brand.
Right, the culture wars aspect, potentially.
Potentially, yeah. Another big category is uncontrollable events, things like health concerns, natural disasters. They specifically mention hurricanes Helene and Milton closing Walt Disney World recently.
Ah, right, those hurricanes.
Also, international political or military developments, general macroeconomic conditions like recession fears, supply chain disruptions, all those external factors that can hit any big company.
Standard risks, but important ones. Now, what about the very foundation of Disney? Its intellectual property, its characters, its stories. You said this is where it gets really fascinating.
Yes, this is crucial. The value of Disney's IP depends heavily on legal protections, like copyright. And the report specifically notes something major, the copyright for some very early works, like the 1928 short film Steamboat Willie.
The first Mickey Mouse cartoon.
Exactly. And the early versions of characters depicted in that film that copyright has expired, it's now in the public domain.
So anyone can use that specific version of Mickey from 1928.
Legally, yes, within certain limits. And the report acknowledges other copyrights will expire in the future. They explicitly state that as copyrights expire, they expect revenues generated from that specific IP to be negatively impacted to some extent.
That feels like a huge shift for Disney.
It is. It's not just a legal footnote. It's a fundamental challenge to their historical model. As these iconic early versions enter the public domain, Disney faces this strategic imperative to, innovate even more aggressively, not just with new stories, but in how they leverage their currently protected IP to stay unique against this growing sea of public domain content that others can now use.
That's a really interesting point. What other IP risks did they mention?
They also face challenges from AI tools, potentially creating infringing works based on their characters, and ongoing risks from third parties claiming Disney is infringing on their patents.
AI creating knockoffs, another modern problem.
Yep. And finally, regulatory changes are always a risk. U.S. and international rules covering everything from the FCC, privacy laws, trade restrictions like tariffs, and crucially, emerging AI regulations could all impact their business and profitability.
That's a complex web copyright law, AI, global regulations, a lot for them to navigate. Any final notes on how they plan to report their financials going forward? You mentioned a change.
Yes, this is important for anyone tracking the company closely. Starting in the first quarter of fiscal 2026 for Disney Plus and Hulu.
So not immediately, but next fiscal year.
Right, and starting even sooner, Q4 of fiscal 2025 for ESPN Plus. They plan to discontinue giving quarterly updates on paid subscribers and that AMRPU metric.
Stop reporting subscriber numbers quarterly. Why?
They state it's due to their evolving DTC strategy and the maturing market. They feel those specific metrics might be less relevant going forward. They will also consolidate some entertainment reporting, but promise they'll still provide information on overall DTC profitability.
That's a pretty significant shift in transparency, especially for the streaming numbers everyone watches so closely.
It is. We'll get less frequent specific updates on subscriber counts.
Okay. Well, we have certainly covered a lot. We've seen a company posting, impressive top-line growth, surging net income a lot, driven by that strategic Hulu acquisition and tax benefit, but also real strength from parks and sports.
Definitely.
Yet they're also navigating some really complex challenges, changing consumer tastes, those intense legal battles, and this really fundamental shift in the landscape for intellectual property, like those early copyrights expiring.
Mm-hmm.
So hopefully you now have a much clearer understanding of the financial engine driving Disney. This isn't just about abstract big numbers. It's really about how a massive entertainment company is trying to adapt to a rapidly changing world and what that means for, their movies, their shows, your park visits, and ultimately their bottom line.
Absolutely.
Mm-hmm.
And as Disney keeps innovating, building new cruise ships, making deals like the NFL one, navigating AI and content technology, and facing these evolving IP challenges, maybe a final thought to leave listeners with. What uncharted waters do you think pose the biggest risk or perhaps the biggest opportunity for them in the coming years? Something to mull over.